we're not going to it for others. They'll find us along the way. Okay, so the last time we met, I think we were discussing on the appraisal. We discussed on the NPV, the case of replacement decision, discussed on the MIRR, as well as we also discussed on how to get the internal rate of return. Okay. So today, I want us to can simply discuss on the financing, especially towards the right issue of shares. Okay, as you've come up with ideas on which area you think we can pay more concentration on in this particular last class we have. Okay, so let's look at the right issue of shares. Okay. So under the right issue share, okay, under the right issue shares, okay, we see that here the company does give its current shareholder the options of subscribing the company new shares at a discounted price. Okay, so therefore the current shareholder of the company are granted by the company the option of them taking up an extra share, okay, at a price that is discounted from the current market price per share. Okay. Okay, if for example, one share, if currently the current market price per share of the company is equal to, let's say, 20 shillings, okay, then the company may be offering, okay, the offer price, which you call the issue price, okay, the issue price, okay, could be, for example, let's say 20% discount. Therefore, the current shareholder will be paying 80% of the current market price of 20, which gives us 16, I guess, is to give therefore 16, okay. Therefore, the current shareholder are given that option of buying company extra shares at a discounted price. Okay, and you mentioned that this particular offer is only available to the current shareholder. Okay, it's only available to the current shareholder. Okay, it's not available to the members of the public, only to the current shareholder. Okay, however, as a shareholder, don't forget it is an option. It's not an obligation you have. It's an option. Okay, and this option you have, okay, you can decide, okay, I will maybe buy the shares, okay, in short, you will exercise the right, okay, you can decide that, let me buy these extra shares that are being offered to me by the company. Therefore, what do you do? It means you are exercising your rights, okay, exercise the right, therefore, okay, in short, therefore, you buy the shares being offered to you, okay, you can decide these rights, okay, they're only available to me, they have a value, okay, I don't want to buy the extra shares, so what do? I can decide, you can decide to sell off the company share, so therefore, sell the rights, okay. You say the rights that have been offered to you by the company, or you can decide to ignore. Okay, you can decide to therefore to ignore the rights that have been offered to you. Okay, as we mentioned, okay, it is not prudent for you as a shareholder to ignore the right. Okay, because this will illustrate a decrease in your wealth. Okay, the other two will ensure that your wealth remains constant. But in case you ignore the right, then your wealth therefore will be decreasing. Okay. Therefore, you normally say that it's worthwhile for you as a shareholder. You can either exercise the right or sell the right, but not to ignore the right. Okay, it's not worthwhile for you to do that, okay, ignoring the rights, okay. And you see that as a company, not even the company, you as a shareholder, you can be able to anticipate, okay, what should be, okay, what should be the share price, okay, what ought to be the share price after the expiry of the offer, okay. And if we refer to it as the theoretical exercise share price, okay, refer to it as the theoretical exercise share price. Okay, theoretical exercise share price, okay, yes, this is the share price, okay, which we are anticipating upon the expiry of this offer, what ought to be therefore the share price, okay, what ought to therefore to be the company share price, okay, it should be given us, okay, it is equal to what we call it's a weighted average, okay, value the shares of the company after, okay, after the rights have expired, okay, is a weighted average value of the company share, okay. If, for example, the company in this alternative year, okay, if the share price here was it's the current share price is 20, the offer price is 16, okay, and assume it's a 144, that means therefore you're going to get one new share for every 4 shares you have in this company. Therefore, the theoretical exercise share price of this company, okay, will be equal to, you're going to get one new share, but you pay 16 shares for it, okay. For you to get this one new share, you must have 4 shares. Therefore, the value of these 4 shares, therefore, is 4 times 20, because the value of this is old shares, the old share quote, okay. Therefore, the theoretical exercise share price, therefore, will be equal to, we divide by the total number of shares you have. You have 1 new share plus the 4 old share, therefore 5. Okay. That's therefore the theoretical exercise share price is simply a weighted average value. A weighted average value. It's that as a shareholder, since you have the right to buy the new share, okay, since you have the right to buy the new share, you can decide to sell them, okay? They can say they have measured it here. Okay, you can decide therefore to sell the rights. Therefore, what is the value of the rights? Okay, well, you see that when it comes to determination of the value of the rights, okay, the value of a right, we use two methods, okay, value of a right, okay. Again, determine the value of rights using two approach. Either, depending on how you define the number of rights to be equal to. You can define the number of rights, okay? You can define the number of rights to be equal to the current shareholder, to be equal to the existing shares, to be equal to the existing shares. Or you can define it to be equal to the new shares to be offered, the new share be receiving, to be equal to the new number of shares, okay? If you define the number of rights to be equal to the current number of shares, then instead of the value per share is given us, okay, the current market price per share, okay, minus the theoretical exercise share price. In short, these new shares, this current share you have, currently, this four share you have, what's their value? It is 20, okay? Once the offer has expired, at what's the drop in the price? Is the drop in price? Actually, what is here? What is the theoretical exercise share price here? In this example, what's the theoretical exercise share price here? 19.2, Joshua. Joshua, 19.2?
Yeah.
Okay, 19.2. Okay, therefore 19.2, therefore share needs to be the share price. 19.2, therefore the share price. Okay, which means therefore what's the drop in the price of this share? The price was 20. It has dropped from 20 to 19.2. Okay, but we say this is the price after the share. This has all expired. Okay, 19.2. That means therefore, what's the drop in price? It's from 20 to 19.2. Therefore, the value of one right therefore is equal to 0.8. In case we define it, if we define the number of rights equal to the current shares the shareholder has. Okay, if we define the number of rights we got the new shares, okay, if we define the number of rights we got the new share, what does it imply? And therefore, what will be the increase in price? Don't forget the new share, okay, you bought them at 16. Okay, where is this? The 80s. Okay, you bought them at 16. Okay, there was increase the price of this share. Okay, the increase from 16 to 19.2. Therefore, the value right, therefore, be equal to 19.2, okay, minus 16. The increase from 16 to over 19.2. The value right to be equal to, I think, 3.2, guess. Yes, we get therefore 3.2, therefore, to be the value of a right. Okay, if we define them to be equal to the new share, the increase in the value from the 16, okay, or the 19. Or in case we define them to be equal to the current share you have, the drop in the price from 20 to 19.2. Clear? Question? Okay, no question. Let's see if I can get a question. I don't know whether in the MOOC there's a question. Let me see whether I can. I'm not so sure about that. Let's see. Mock paper. Where is the mock? Okay, I'm not sure whether it's a side question. Okay. I don't think there's a question. Okay, we didn't have one. So let's check on our question bank, or in case we have one question, you have a question, then that should be quite helpful. Do you have any question regarding this rights issue shares? I think I have one here. No, I don't think you have this question. It's in, this is, which series is this? It's a June 2010 question, okay? So I think the best thing I can do here is share the question with you. Okay, so check what's up. Check here. Okay, so go to that question. That question 4A. So go through it, then we discuss together. Sorry, I forgot to unmute myself. Okay, so this company, you may know that it's an all equity finance company, which implies therefore the company is purely financed by equity shareholder. That seems what it means. Which implies therefore the company, the cost of capital for the company is equal to the cost of equity for this company. Okay, therefore we need to estimate what ought to be the company cost of equity. Okay, based on the formula. This is based on the dividend growth model. This is on the dividend growth model. Okay, which means therefore the company, the cost of equity is therefore D naught, the dividend, which has just been paid. The company has just has paid 23. This is because for D naught, the most recently paid dividend. The growth is 6%, P naught 30, and it was the 6% is the growth in the dividends. Therefore, to give us how much we have for the company cost of equity, which is equal to the company cost of capital. You get how much the cost of equity? Confirm quickly, we move on.
16%.
Okay, exactly 16%, exactly.
Yeah, I'm getting 15.999.
Okay, 16%, okay. Therefore, the company cost of equity, which is equal to cost of capital, therefore is equal to 16%. Okay. Now, based on that, therefore, we can now be able to estimate what ought to be the NPV of this investment. Okay. What's the NPV? The company wants to invest this 120 million in a project where they'll be earning 16.8 million per year. There was the NPV to be received from this investment. The NPV from this project, therefore, will be equal to the present value cash flow. Okay. Minus initial cost, which is equal to present value, is earning 16.8 million to infinity. Therefore, we divide by the cost of capital, 16%, minus the initial cost, which is equal to the capital the company wants to issue, 120 million. Therefore, what comes to the company NPV if they go ahead with the project? Sorry, how much do you get?
Negative 15 million.
Negative 15 million. Okay. Therefore, if the company goes ahead with this project, then the company NPV will be negative 15 million. Therefore, that's the become therefore a loss in value of the company, which implies therefore if the company was to invest in this project, then the NPV per share, okay, the NPV, okay, per share, NPV per share, therefore will be equal to, you're getting negative 15 million, but this is for all the shares of the company, okay. We divide by the number of shares. This company has how many shares? We need to get that, okay. You've been told that the company has a market cap, the company market total market value of the company share, okay, is equal to 720 million. It's giving us the number of shares times the current market price per share, which is equal to the current number is 30. Therefore, the number of shares is therefore 720, and number of shares of the company, current number of shares of the company, therefore, is 720 divided by 30. 720 million divided by 30 to give us how much? 24 million.
Yes.
24 million. Okay, therefore you get 24 million, therefore, to be the number of shares of the company. Therefore, the NPV per share, okay, therefore we equal to the NPV to NPV, we divide by the number of share, which is equal to 24 million. To give us how much? 0 point, negative 0 point.
625.
63. Okay, therefore negative 0.63. Therefore, we count for the NPV per share if the company goes ahead and makes this investment. So this is a negative. This is a loss in value. Therefore, the NPV, the right share price, therefore be equal to the current market price per share plus the NPV generated per share plus the NPV per share and per share. Therefore, 30 minus 0.63. Okay, therefore this therefore give us therefore 29.37, I guess. For the right share price. Okay, so if it was a positive, therefore the company's price, the company value will be increasing, but this is a negative. Okay, so therefore there's a drop in the share price from 30 to 29.37. Clear? Question? Okay, no question. The next part, that is, oh. Yes.
Could we do another question like that?
Yes, you have one. Do you have one?
Or you can repeat that one.
Where did you understand? Well, the best thing is for you to come up with a question. You tell me this question, which I think we can do together.
We have no other question, but the concept is not well in.
No, there are very many questions. If you have the question, but
December 2012 question.
Sorry?
December 2012 question 2C.
It's 712 question 2C. Okay, let's finish this and then you can check on that one and say, let's first finish on this one. Okay, therefore, to be the Camry share price. Okay, the Camry share price will come for 29.37. Okay. Now, next we just create the theoretical exit market price per share and the value per right. The theoretical exit share price. Okay. Don't forget, first thing we need to get therefore is how many shares are we going to be issuing? Okay. So first, the capital the company want to raise is 120 million. Okay, given us a new number of shares. Okay, new number of shares that we need to issue. We multiply by the offer price. The new capital we need is 120 million. The new number of shares, which we don't know, this what we want to calculate. Okay, the number of shares. The offer price we got was how much? I can't remember. We have not done it. Okay, we have not done it. It is okay. It's given there. It's 25. It's only given there 25 times 25 in the question. Therefore, the new number of shares. Therefore, equal to 120 million. We divide by 25 to give us how much? To be the number of shares to be issued. $4 million.
4.8 million.
4.8 million. Okay, therefore, the number of shares to be issued. We compare that with the company. I think we have that already. Okay. Therefore, the theoretical exit share price is the value of the new shares, which is 120. We are here already. But the value of the old share, which was 720, given the question, we divide by the total number of shares after. Okay. The old shares, there were how many? There were, where are they? Yeah, I think we've done that part already. You have it here. They are 24 million. Okay. The new share, they are 4.8 million. Therefore, combined wise, the number of shares therefore will be 24 million plus the 4.8 million new share that we have just issued. To give us therefore also the value per share after. Don't forget, this is the value of the old share. This is the value of the new shares. The value of the old share. This is the new number of shares. This is the new number of shares, and this is the old number of shares. Because we want to get the value per share. It's simply a weighted average. Can you get how much? 20.
Uh, 29.17.
29.17, and therefore the theoretical exit share price, simply a weighted average value. So question on this example. Someone you didn't understand?
Kindly repeat on part 1.
Part 1. Where exactly? Now you have to pinpoint where exactly.
I don't get the concept where we said that the Camry price is the current share price minus the dividend.
Huh? No, what you wanted to get is
minus the NPV.
Minus the NPV. So first, we just want to determine, okay, where are you going to be investing these funds? Okay, you're going to be investing these funds in a project that is going to be earning for you 16.8 million per year. Is it clear there? You're going to invest this money in a project that's going to earn for you 16.8 million to infinity. Clear?
Yeah, clear up to there.
Okay. Then we discount back to year 0. We want to get the present value of the project. Therefore, we discount back to year 0, okay, by 16%, okay, minus the initial investment cost, which was we have spent 120 million to invest in this project. There was the NPV. We got a negative 15 million. Clear?
Clear.
The value that you have created is a negative. Okay, we have it here, negative 15 million. Total value. What about per share? What about per share? You divide by the number of shares you currently have. This company, how much share do we have? 24 million shares. Therefore, there was the NPV per share is equal to negative 0.63. Clear?
Clear.
That means, therefore, if as a company we were to invest in this project, our value will be decreasing by this much, 63 cents. What's the current value of the company? What's the current value per share of the company?
30.
30. What's the loss to value?
Negative 0.63.
Yes, therefore, our new market per share, 29.37.
Clear.
Okay, great. So you had a question from December. You had a question. Another question that is. Who was it?
No,
There's
not
someone who
me.
had a question. So it was from where? Okay, seem to be no one.
December.
Sorry, it was
December
in December
2012
2012.
question.
December 2012 question.
No, November 2011 question 2C.
November 2011.
Yeah.
November
Sir,
2011. Sorry?
before you proceed, we
Yes,
have
yes.
not done the part on the value of the rights.
Oh, the value. Okay, yeah. Thank you. Yeah, we know that part of the value of the right. Thank you. Therefore, the value of the right here, okay, your examiner is very vague here because don't forget, as you said, can get the value of the right from two ways. Okay, so I don't know what the examiner wanted us to get the value of the right to be equal to. Anyway, let's do that both method. Okay, the value of a right. Okay, let's do the two methods. Okay, if you define the number of rights to be equal to the new shares, or in case you define them to be equal to the existing share. So I would propose that you tell the examiner, I assumed by the number of my rights are equal to this. Okay. So therefore, let's assume that therefore you define the number of rights to be equal to the new share. Therefore, the value is theoretical equity price minus the offer price, which is equal to 29.17 minus 25. Therefore, 4.17. Okay, if we define the number of rights to equal to the current share you have in the company, the value per right is equal to the current market price per share minus the offer price. Sorry, minus theoretical minus theoretical exit share price. Will be equal to current PS is 30 minus 29.17, therefore 0.83. Okay, so I would propose you tell the examiner, hey, my rights are equal to the new shares, or my right is equal to the existing number of shares. Clear?
I have a question.
Yes.
Could you scroll up a bit? On calculating the NPV.
Oh, NPV.
Why do we divide it by the cost of capital, the cost of equity?
Equity, because that's the cost of capital for this company. You want to get the present value, isn't it?
Yeah.
What's therefore is the cost of financing this project? What's the cost of capital? 16%. Because this company is an all equity finance company. Can you see that? That should be, I think, in the first line there. This company is an all equity finance company, which means therefore its cost of capital is equal to cost of equity.
Okay.
It's clear?
Yeah, thank you.
Okay, great. Okay, so there's someone with a question from November 2011, question 2C. Okay, question 2C. So for those who don't have the question with you, let me share it with you. Okay, go through it. Then you type together. I'll share it on the group.
Sir, before you move on,
Yes.
in this question, haven't we taken care of the growth in the project cash flows? Because we've been told that they will be growing as the dividends also grow.
They'll be growing the company cash flow. Maybe these are the cash flow from the company itself, not from the project. The project cash flows and the rate per share have an equal growth rate of 6% per year. I don't know what that they want to mean that. Because if you check here, the first line there, the project is expected to generate cash flows of 16.8 per year per annum to perpetuity. So I don't know what that particular second statement want to imply.
The projects.
So I'd go with the first statement. Sorry?
They are specific. The project's cash flow and the dividends have an equal growth rate.
So you see that the two statements are contradictory. Okay, we can see that.
Yeah, true.
Yeah, so I don't know what I don't know what you meant to do there. Because as for the first line, the project is 16.8 million per annum to perpetuity. So it's not growing at all. Then they come back below there, they tell us the cash flows are growing. That's too confusing.
Okay.
So I would want to assume they don't growing. We go as per the first statement there. Clear?
Yeah.
Okay, great. If you assume they're growing, you can also assume that you can make that also as assumption. You can assume they're also growing. Okay. If you make that assumption, then you may want to therefore make adjustment. You can assume that way, by the way. Okay, that they're growing. But if you do so, then NPV, of course, you'll be having a different array of calculation. And let's assume, by the way, okay, they're growing. Okay, let's assume that they're growing here. If they're growing, then the NPV will be equal to, okay, present cash should be 16.8 million. They're growing at a rate of how much? What's the rate? Growth 6%, 1.06. We divide by cost of equity 16% minus the growth 0.06 minus the NPV minus the initial cost, which is 120 million. Then we get the NPV. What would be the NPV? Do it fast. What do you get? So this is 0.06, not 0.6, 0.06. You guys do it fast. You get 50. Just fill this in your calculator. It'll give you an answer.
58.08 million.
58.08 million.
Yes.
Therefore, the NPV per share, therefore, will be equal to 58.08 divided by number of shares, which are 24 million. And we get 2 points. So these are sharing, not dollars.
42.
2.42. We get 2.42, therefore, the share. Therefore, the common share price here, therefore, will be equal to, therefore, equal to 30 plus 2.42. Together, that's 2.42. Therefore, you have to examine what you have done, okay, at the beginning, because the two statements are contradictory. So it depends what statement do you follow, okay. So this can be another approach you follow in case you assume they are growing, okay, the cash is also growing, okay. But if you assume they're fixed, okay, like what you've done here, then you can for the NPV, the current share price. Clear? Okay, great. Go through the question that one of you had asked, okay, which I've shared on the group. Okay, so this example is exactly like what you just done together in the previous question. We want to get the company right share price. So first you need to determine how much money do you need, capital 25 million, the cash flow to be generated from this investment, 7.3 million, cost of capital 15%, and you can get NPV. Therefore NPV for this, therefore be equal to the cash flow, 7.3, the present value cash flow, 800, discount back to year zero, and the company cost capital minus initial investment cost, which is equal to 25 million. And therefore, what's the NPV?
Wait, excuse me, sir.
Yes.
For the present value, I thought because it's not in perpetuity, we are not supposed to divide by the discount rate. They said it's a 10-year economic life.
Oh, it has a 10-year life.
Yes.
Ah, okay. Oh, thank you. Okay, how did let that? So the life, 10 years. Okay, thank you. So since this is 10 years, we should not assume that this is perpetuity. Thank you. It has a life of 10 years, therefore, times present value and factor, 10 years, 15%. Thank you for that. Minus initial cost, which is equal to 25 million. Thank you. What's that, PB? NPV? Yeah, but this is an easy one. Should be able to get NPV very quickly. Yes, the fact of the tables. You have the tables with you.
11 million
11 million,
998
998,
922
322,
922.
922. Therefore, the NPV per share, therefore, be equal to, we divide the NPV, we divide number of shares. This company has how many shares? It has 4 million fully paid shares. Okay. Therefore, 11 million, 998, 922. We divide by 4 million new shares of this company. 2 points. 2.9.
Yeah, it's 2.999.
Okay, 2.99. Okay, so 3 more or less. Okay, 3. Therefore, the next therefore got therefore 3. Therefore, the come right share price therefore. The come right share price therefore will be equal to come right market per share will be equal to the current market price per share, which is equal to how much? 18 plus 3. Therefore 21. Question?
Why do you, when finding the NPV per share, why do you use the current number of shares, not the new number of shares to be issued?
Because the come right is before the rights. It's before the rights. Because
Okay.
if you include the number of rights, then this is not come right. It will be X right. Do you get it?
Yeah. True.
Okay, great. Okay, come right is before the rights. Before the rights. Any question? Okay, great. If there's no other question, then I don't know. What else?
I have a question.
Yes.
Again, you.
Sorry?
I'm saying I have another question which I'd like us to do. So it's the question bank. It's November 2018.
November 2018 question.
Question 1C.
Question 1C. I want to take question 1C. Okay, that's what I wanted to come to that area. Okay, fair enough. Let's come to it then. November 2018 question 1C. November 2018 question 1C. Go through it, we discuss together. So in this question, maybe there's some formulas which I think could be worthwhile I share with you if I haven't done that in the past. So let me open my notes here. Okay, so when it comes to the gearing, okay, we can evaluate the company gearing from two main perspectives, either from what we call the financial gearing, or also referred to as financial leverage, okay, or from what we call the operating leverage, okay. No, this is not, I think, on the e-learning anyway. So when it comes to operating or operational leverage or operation gearing, we are trying to estimate, okay, to what extent is a company at risk, okay, or the company might be unable to pay for its obligations, okay, or the company may be unable to achieve its objective simply to make profit, okay, simply because it has huge obligation it has, okay. And this includes the interest, okay. As a company, what are the chances you may be unable, okay, to pay for your obligations, okay, simply because you have the industry you are in, okay, you do carry a lot of cost with you, okay, mostly fixed costs, okay. That's referred to as the operational leverage, okay. And one way you can evaluate is by use of this formula, okay. Using contribution, we divide by profit before interest and tax, okay. Contribution, you divide by profit before interest tax, or you can use another formula here. I suppose you've taken note of the formula there, or you can use this formula here, okay. The change in the profit before income tax, you divide by the change in sales, okay. Well, two formulas you can use when it comes to evaluation of the company level of operating leverage. The extent to which the company, you may be unable to achieve your objective to make profit or even to make losses. Why? Because of the high fixed costs, okay, you are involved in. Because of the high fixed costs, the industry you are in has, okay. That's on the operation leverage. Now towards the financial leverage, okay, okay, this is what we call is a measure of the company financial risk. Is a measure of the company financial risk, okay. Is a measure of company financial risk. Okay? The extent to which as a company you may be unable to pay the holders, to pay them interest, okay, to pay them even in the case of preferred dividends. Why? Because the way because simply you have too much debt with you, okay, because you're financed by too much debt, okay. Then the chance you may be unable to pay for your obligation. Why? Simply because of the way you are financing yourself. The use of, for example, the use of excessive debt than your capacity. That refer to as can refer to as the degree of financial leverage. Okay. The number of risks you can use, okay, and yeah, some of the risks you can use to evaluate the company degree of operation leverage. So take note of those formulas. So here, DCL, I mean the degree of combined leverage. The degree of combined leverage is given us the degree of operating leverage, we multiply the degree of financial leverage, okay. Okay, do I presume you have taken note of the formulas? Okay, fair enough, I assume that you've done that. Okay, let's therefore apply it in this question here, doing here. So that's required, you need to get the degree of operating leverage, degree of financial leverage, and degree of combined leverage, okay? So based on this information, The fixed cost, okay, of the company is 5.8 million. Variable cost ratio is 0.8. Okay. So if the company sale, what's the company sales here? In note 4, the company has sale equal to 8 million. Therefore, the company, the contribution for this company, therefore, is 80% because the variable cost is 20%. Is 80% of the sale, and the sale is equal to 8 million. You're therefore 6.4 million. Therefore, degree of operating leverage is contribution. We divide by the company profit before interest and tax. The company profit before interest and tax is a contribution, okay, minus fixed cost, 6.4, minus fixed cost, which is equal to 5.8. Yes, 5.8. Together for 0.6 million. Therefore, degree of leverage, therefore, is contribution, which is 6.4 million, divided by the profit for tax, which is equal to 0.6 million. You guys how much? 10.67. 67. Okay. Now, in case you have a very high leverage, that implies that you have a very high cost as a company. Okay. In case you have low, then as indicated, therefore, as a company, therefore, you are able to manage your fixed cost well. So in case maybe another company has a ratio of, let's say, 5 times, then this company is better off in terms of managing its fixed cost. Okay. That's the degree of operating leverage. A very simple example. Okay. And 4 marks. Then we have, next we have the degree of financial leverage. The degree of financial leverage. Okay. We need to, so based on those formulas I've given you, okay, we need to, which one do we apply here based on the information provided here. Here we have, do we have interest? Yes, as per what you can get the interest. No, 2, you can get the preferred dividend. Okay. So the company degree of financial leverage, I want to see which formula we need to use. Is earning before interest tax. We can use the first formula. Okay, degree of financial leverage. Okay, I'm giving us the earning before interest tax. Okay, we divide by earning before tax, or simply earning. You simply subtract the interest. We therefore be equal to the earning before interest tax. We have done that already. 0.6 million. This company, how much interest do you pay? I think we need to do that. The amount of interest the company pays as per note 1, 2 million, and pay at a cost of 2 million, and pay at a cost of 8%. 8%. They will give us equal to 160,000. 160,000. Okay. Therefore, consider earning before tax for this company is earning before interest tax minus interest equal to 0.6 million minus 0.16 million to give us 440, I guess. And get it for 40,000. Therefore, the degree of financial leverage, okay, the DFL, is earning before any tax, which is 0.6 million. We divide earning before tax, which is equal to 0.44 million. 1 point.
$3.6.
1.36. Okay. 1.36. Okay. Don't forget the difference between the numerator and denominator is simply the interest. Okay. So in case you're paying a lot of interest, then this value becomes very low, and therefore the degree becomes quite high. And we repeat, in case you're paying a lot of interest, the value here becomes a very low figure here. Okay. And therefore you end up therefore having a very high degree of financial leverage. The higher the figure, the more risk you are as a company in terms of use of non-owners capital, the use of debt finance. So in case you have another company that has a ratio, let's say of how much? Let's say a ratio of, let's say 0.5. The company that has a ratio of 0.5, okay, might be deemed to be better. Okay, might be deemed to be better. Why? Because they are paying less interest. That's why the value here, the denominator here the denominator, therefore, that's why it's close as possible to the numerator here. Okay, if for example, just to give an example, if we have another company paying an interest of, let's say, 50,000, okay, there's an assumption, we have a company here paying 50,000, then the company, the gearing of this company, the leverage of this company will be 0.6 million. We divide by 0.55 to give us 1 point. You get 1 point. Okay, you're just dividing. There's no complication.
One 1.0909.
Okay, 1.09. Okay, as you can see, therefore, since this company is paying a low amount of interest, it has a very low degree of financial leverage. If you pay a lot of interest, then therefore you end up with a high figure. There was a similar question. Actually, I think, let's see if I can get it.
Where does the 0.6 come from, sir?
Sorry,
0.6 million.
0.6 million.
Yes, the PBIT, the EBIT, I mean.
Yes. I don't get your question.
Like where have we gotten that value?
This here, this is the value here. It's a continuation of the same question.
No, like where did the value come from initially?
Here it is.
Okay.
Yes, no, it was a company, simply company profit, contribution minus the company fixed cost.
Fixed costs. Okay.
Yes. So it gives 0.6 million to the company, therefore the company profit before interest and tax. Clear?
Clear.
Okay, great. So there's another question, which I don't know if I can get it, which more or less apply the same. I mean, you are meant to apply the same concept. If I get it. Oh, here it is. So this is in November 2016. November 2016.
You have not completed the question. Degree of
It's not
combined
complete.
leverage. Yes.
Okay, DCL, degree of combined leverage. Sorry, degree of combined leverage is degree of financial leverage times degree of operating leverage equal to, we got the leverage here to be equal to 1.36. Degree of financial, degree of operating leverage was equal to 10.67. Times 10.67. And you get how much? 10 point. Degree of financial leverage times degree of operating leverage. You multiply and you get how much?
14.51.
13.51 times, okay, 13.51 times the degree of combined leverage. Clear?
It's 14, not 13.
Oh, 14. 14.51. Okay. Then the next question here of November 20. Last question, 2016. Question 5C. Okay, go through it. We discuss together. Okay, I suppose you've gone through the question, so let's attempt it together. Giving us the percent increase in the company taxable income if earning before in tax increased by 6%. Okay. If you remember the formulas that I gave you, so first the DOL is simply equal to contribution. Okay, we divide by the profit before in tax, or okay equal to percentage in earning before in tax. Okay, we divide by percentage in sales. So let's see, we can apply that formula here. There's any increase in sales, we don't have it. Okay, DFL. Okay, so you're given us. Okay, so I want to see the formulas that you can apply. Okay, to determine the increase in the taxable income if earning before in tax increased by 6%. This was earning before in tax. We divide by earning before tax. Earning before tax and before tax. Can you get that from the information given here? Can get that? I think you can get that for sure. Yes, they've got therefore. Earning before tax for this company is 0.6 million. Earning before tax is equal to 0.525, and you get 1 point.
One four.
1.14 times. Okay, 1.14. Next, we can earning before. Let's say apply this formula. Earning before taxable income. If earning before income tax is going to increase by 6%. Okay, I think we're going to apply more than one earning before tax. Increase by 6%. Okay, let's we can use this formula. Okay, this can also be given us. DFL can also be given us. Okay, change in earning before into the tax. We divide percentage in earning before tax. We have it equal to 1.14. It be equal to the increase in earning before into tax given to us 6%. 6%. We divide by earning the percentage in earning before tax, which I think is what we've been asked here. Yes, therefore, this will give therefore percentage in earning before tax be equal to 6% divided by 1.14. Give us, I don't know.
%5.26%.
5.26%. Okay, so we're done with number one. Okay, simply trying to sort of work backward. Okay, that's number one. Number two, we're going to get the percentage change in earning before in tax if the sale increase. And I think you have that formula here. Yeah, see it earning before in tax. We have it here. Yes. Increase sale, we have it here. Yes, I guess we can apply the formula. But I think we need first to go to know the DOL based on the first formula here. The first formula here. Okay. The DOL will be equal to contribution, and the contribution here is equal to 2.1 million. We divide by the profit for in tax, which is equal to 600,000, 0.6 million. 3 point.
3.5.
3.5 times. Okay. Now we can apply the second formula here now. Okay, we know the DOL. Now let's apply the second formula. DOL is equal to 3.5 is equal to the percentage in the company earning before in tax, which we've been told is equal to, that will be in us actually. That will be in us for. We divide by the percentage in the company sales, which is we have been given 10%. The percentage therefore in earning before into the tax, therefore 3.5 times 10%. Therefore that 5%. Clear? Okay, that's Roman 2. Roman 3, you've been asked the percentage in taxable income. Okay, the taxable income. This is the taxable income. In case the sale increased by 8%. If the sale increased by 8%, okay, let's do the DOL. Okay, if the sale increased by 8%, so degree of operating leverage, we will tell is equal to 3.5, which is equal to here the sale increased by 8%. If sale increased by 8%, what will happen therefore to the increase in earning before into tax? We know the sale is going to increase by 8%. Therefore, it will be equal to 8% divided by percentage in earning before into the tax. Therefore, percentage in earning before into the tax, therefore, will be equal to 3.5 times 8%. Gives how much? 28%. confirm. $3.5 times 8.
Yeah, it's 28%.
28%, great. So since now we have there the change in earning before tax, which I think we can apply it here in this formula. We have the denominator here, okay? We have the DFL. I guess now you can get the earning before tax. Now we have the numerator. You have the numerator here, earning before tax. So therefore, we can now get the denominator here. Therefore, DFL we got was equal to the percentage in the company earning before tax. Okay, divide percentage in company earning before tax. Okay, therefore, we have the earning before tax change 28% here, so we can get the percentage in earning before tax. The percentage in earning before tax is equal to the percentage in earning before interest tax. We divide by the DFL, which is equal to 28%. You done it here. DFL we got 1 point something. I can't remember. DFL was how much? It's here 1.14. Okay, we do it for 1.14. And get how much?
$25.
25%.
Yeah.
25%. Therefore, the change in the tax of the percent tax of income, your sales of 80% is registered. So it's simply just playing aloud with the formulas. Actually, there's no it's easier done here. Clear? Question?
Kindly scroll up 1 minute.
How up should I go?
Like where we began, the very first one.
This way I began.
Or like the first part 1. Okay.
This is where I began. Oh, what do you prefer to one?
This one.
This way I began the question.
Yeah.
Okay.
So, but these are concepts in section 5.
Not really. Okay. Can you see section 5 as per se? I don't think. Okay. I don't think a question for section 5 part. Okay. But sometimes your examiner is confused to an extent that the syllabus overflows to the next area. So don't be surprised to find them also in section 5.
But we never did them in section 3.
You didn't do them. Are you sure?
This degree of financial leverage. No, I don't remember us doing them.
Who was your
Section
lecturer?
3.
Was I the one?
Yes, you are the one. From January to July.
Are you sure?
We never did these things, sir.
Okay, in case we did do them, then that's the time then. But essentially, they are not, okay. It's not like I should go, okay. Because the gearing and capital structure is in section 5, as you are saying. But
Yeah.
since it has been tested in the past, okay, I normally have the notes on the e-learning. I hope you could normally go through the notes, those notes, by the way.
Yeah.
I hope you know, because these notes are already on the e-learning, okay? So it's not, I don't know what you can say. I don't think that's a topic as per se. So the best thing I normally do is I normally do questions. So in case we never did a question, then we ought to have done one for sure. Anyway, here you are. Sorry?
But there are many concepts.
Sorry?
Many concepts in this FM have gone through the question bank. Most of them are section 5, including things like modified internal rate of return,
Yeah, this is your
discounted payback
examiner.
period.
So yeah, this is your examiner. You never know. So just prepare yourself. Okay. I don't know. Just ensure that whatever you have done, you know it. Just in case it brings something else out of the scope, okay, you already passed the exam either way. So just prepare yourself mentally that there could be some question that, okay, you never know where they come from. That's the idea. Yes, this is Michelle. Michelle, you had your hand up.
Yeah, could we do a question from the same sitting, November
Yes.
2016, question 3A?
2016 November, question 3A.
Yeah.
This is on the Georgina company.
Excuse me, sir.
Yeah.
Before we move on,
Yes.
before we move on the notes on e-learning, which topic will I find?
Gearing and capital structure. Gearing and capital structure.
Okay.
So gearing and capital structure, that's where you will find these notes. So, Michelle, I suppose you want to be Georgina Limited?
Yes.
Okay, fair enough. So this is sitting, this is which sitting is this? This is November 16, November 2016. Question 3A. Okay, then go through it, we discuss together. You need to determine the amount of external finance required, the forecast finance statement, and you mentioned weakness of the process you've done. So first you need to determine, you're using what called the percentage of sale method, okay? So first we need to determine what's the percent of sale for each of the account you have there. So begin with the plant machinery, okay? So allow me to use Excel. Okay, so the first thing, of course, is to get the percentage of sale of each account of the company. Therefore, the first account is plant and machinery. And the percent of sale is the investment the company has made in that particular account, which is equal to 31,200. Okay, so I have them in thousands as they are. We divide by the sale for the company at that point in time. The sale for 2016 was equal to 120 million. This is 2015. Yes, 2015. And the sales was equal to 120 million. Okay, now therefore give the percent of sale, the percentage of the account as compared to the sale. That 1.2 million divided by 120. Okay, therefore give us therefore 26%. Okay, clear? That 1.2 million we divide by 120 to give therefore what ought to be the percent of sale for the first account. Next account is furniture. Which is equal to, okay, equal to the account is 18.72 million divided by the sale is 120. Then the next account is motor vehicle. Motor vehicle, and the investment in motor vehicle currently 12.48 divided by 20 million. Next account is inventory, the same process. Inventory equal to the investment we made in inventory, 19.2 equals 19.2 divided by 120 million. Next account is account receivable equal to 14.4 million divided by the sale, which is 120 million. The next account is cash, which is equal to 3.6 million divided by 120 million. Next account, don't forget, we assume that the company long-term capital doesn't change. Okay, therefore, the next account therefore is payable. All the others don't change. And payable is equal to 18 million divided by 120 million. Next is accrued expenses. Okay, accrued expenses equal to 12 million divided by 20 million. That's the first step, okay? Getting what is the percentage of sale for each of the account, okay? All the way from the non-current assets to current liability, except the company long-term capital, which includes equity and the company non-current liabilities. Clear? Question? Okay, no question. Great. Therefore, those kind of for the percentage for each of the accounts. Next, once we done that, is to get the increase in sale. The increase in sales increase is equal to the company sales issue that the forecast is a sale increase by 10%. Therefore, 10% increase in sale we multiply by the old sale, which was equal to 120 million. Okay, let's say 1, 2, 3, 1, 2, 3, and get therefore an increase sale. And then we'll remove the percentages. And get therefore, let me have them in thousands. And get therefore an increase sale equal to 12 million. Okay, to get to be 12 million. So this one, let me change them to percentages. Therefore, the sales is increasing by 12 million. So seeing the sales is increasing, that means therefore we need to invest more towards assets. Okay, increase assets, therefore increase in assets. That means since the sales is increasing, then you must support the sales increase by investing more towards your asset. All the way from first asset, machinery, all the way to the distributor to cash. Okay. The increase in machinery will be equal to the percentage of sale, which you got here as 26%. We multiply by the increase in sales. The increase in sales is 12 million. We multiply the increase in the plant and machinery is 26% times the increase sale, which is equal to 12 million. Okay, together for 3.12. It's the same for furniture, the same for motor vehicle, the same for inventory, and the same for receivable and cash. Let me repeat, okay? This is equal to 26%, which you have here, 26% times 12 million. And this will go to therefore to be equal to 3.12 million. For the furniture, it will be equal to 15.6, if we have it here, 15.6% times 12 million. The same process all the way to cash. Cash will be equal to 3% times 12 million. Okay. So do that from the first account all the way to the last account. Confirm the values. The increase in the assets from plant and machinery to cash.
Yeah, they're okay.
Okay, great. Because for the increase in assets, for each of the account. Therefore, the total increase in assets, here, total asset increase, total assets increase, therefore be equal to, you see we do the summation from the first plant machinery all the way to cash, and I get a sum equal to 9960. You mean that for the company, you have to look where are you going to obtain this money from? Okay, the first finance sources, so the money will come from three sources. So finance sources, financing, financing asset increase, financing of asset increase, assets increase. If will be equal to you finance first, okay. So first, what's the need you have? Your need is 9.96 million. Okay, asset increase. your asset increase equal to 9.96 million. That is what's your need you have. Then how do you finance? Okay, finance sources. The first finance share will come from payables. Okay, from payables. And the increase in payable, okay, was equal to the percentage of sale, which is 15%, times the asset increase, times the sales increase, which is 12 million. The increase in payable is equal to increase in sale, 12 million, times the payables percentage of sale. Therefore, 15% times 12 million, you get therefore 1.8 million. That's the increase in payables. The next finance year is the accruals. Okay, the accrued expenses. Same process, okay? The percent of sale, 10% times the increase in assets, which is 12 million. And get 1.2 million. The increase in accruals, therefore, is 1.2 million. And all these are geared towards financing the increase of 9.96 million. Clear? Okay, that's clear. The next finance year is retained earnings. The company retained earnings. You're going to use the company earnings for the year 2016. Okay, this is for 2016 to finance the needs of the company. So first, we need to get, therefore, what is the new sales? Okay, the new sales of the company is equal to, okay, is 110%. Okay, so it is 10% more. The sales for 2016 is 110% times 120 million. Okay, 120, 123, 123. But therefore, the sales of the company, which is given us 102 million. Then the profit the company is making as per note. Okay, we need to work out because as note 3, the company made a profit of 2015 of 18 million out of sale of 120 million. So if I work in here, let's do a small work here. Net profit margin. Net profit margin equal to 18 million divided by 120 million. And you get therefore a net profit margin of 15%. So we assume the company net profit margin remained constant even in the year 2016. So since you made a sale equal to 132 million, there 15% of it, therefore, is equal to the profits you're making. Then you pay the shareholder 80%. Then what do you remain with? 20%. Therefore, times 20%. Let me repeat. The company sale for 2016 is 110% of 120 million. Okay, the sale for 2015 is 120 million. The sale therefore for 2016 is 10% more. Then the profit margin is 15%. Therefore, we assume it remains constant even to the year 2016. You pay the shareholder 80. Therefore, what do you retain? You retain the 20%. Clear? And therefore, get a profit margin and a retained earning equal to 3.96 million. Now, if these two financials will not be enough to cover your need of 9.96 million, any extra is going to be obtained externally. Okay, you have to go therefore externally and get the money. And how to get the money? From how? In note 7, any extra financing will be through long-term debt. Therefore, I call this long-term debt. Let me just drag this. Then any extra, there is external finance, external financing through long-term debt. To be equal to, your need is 9.96 million minus the finance you have to obtain from the payable, minus finance you obtain from accrued expenses, minus the finance you obtain from retained earnings. So if there's any extra, then you can do so through a long-term debt equal to 3 million. Clear? Okay, so that means that it's okay. That's not one. The amount of external finance that is required, 3 million.
Excuse, could you please repeat on the retained earnings?
Or retained earning, okay? Let me refer back. retained earning of the company is equal to the company sale for 2013 to 2016 is how much? It's 110% of 120. Clear there? The sale for 2016 is 110% of 120 million. Clear?
Yes.
Then the profit margin, don't forget, not all sales are profit. Okay, not all your revenue is profit. Okay, your profit is only 15%. Therefore, multiplied by 15%. Clear? So this, therefore, we just put brackets. This, therefore, is giving us the company profit for 2016. Clear?
Yeah.
Then you pay the shareholder 80% of that profit you have just made. The whole you retain 20%.
Okay, thank you.
Okay, that we have given for attain and equal to 3.96 million. Any questions so far? No question, great. That's Roman 1. Roman 2, okay, you made together for the pro forma balance sheet of the company. So here you can do the balance sheet of the company. So first you get the balance at the balance carried down at the year, at the end of year 2016. Okay, so now this is let me call planned. Okay, what do we call them? Balance carried down. Let me just call them balance carried down. Okay, so being the first account all the way from plant machinery, okay, all the way to accrued expenses, all those, okay. Therefore, they would be equal to, for the plant, beginning of the year, end of 2015, beginning of 2016, the balance, as we have it there, is that 1.2, okay, that 1.2, yes, that 1.2 million, that 200, okay, no, I need to adjust here, plus the increase, and the increase is equal to, you have done that working already, the increase in plant machinery is 3.12, so plus 3.12. Therefore, the balance of the plant machinery end of the year is at 4.32. Furniture, the same process, the furniture balance end of the year, 18,720, plus the increased furniture, which you have it here already, you have 25,592. The motor vehicle is equal to, the balance beginning of the year was 12,480, plus the increase of it here, motor vehicle, which is 1248. In inventory, balance beginning of the year was equal to 19,200, plus the increase of inventory, we have it here. Cash or receivable is the balance beginning of the year, which was equal to 14.4, plus the increase, we have it here, 1.14. Cash, beginning the balance was equal to 3.6 million, plus the increased cash, which you have it here, 360. Okay, therefore, that's 960. Therefore, ensure the total company assets, company total asset is equal to total assets of company, both current and current, is simply equal to the sum, okay, from the plant machinery all the way to cash, and I get 109,560 million. Clear? Okay, great. The company has equity, okay, equity. In the equity of the company, we have ordinary capital. We have here ordinary capital, ordinary, okay, share capital. Which is equal to, is the main constant, okay? There's no any increase in the company equity. In the company ordinary share capital, which is equal to 42 million, okay, as it is given there on the company financial statement, 42 million. Then you have retained earnings of the company, retained earnings. Beginning of the year, the company had retained equal to 17.6 million, plus the retained earnings for 2016, which you have done somewhere. We have it here, okay, 3.96 million. Therefore, by the end of the year 2016, the general is equal to 14, which is equal to 70.6 million plus 3.96 million. Together, therefore, 21,560. Therefore, coming to equity is simply equal to, can do the sum, again for company total equity, which is equal to 63,560. Then the company non-current liability, company non-current liabilities. Be equal to, first we have the debenture, 14% debenture, it doesn't change. It is how much? 10 million. Should be 10 million, not 1 million. Then you have the long-term debt you have just issued to finance external capital. Okay, long-term debt. Now this is external finance, just potential domestic, which you have just done right now, which was equal to how much? 3 million, I guess. Yeah, 3 million. Okay. Then what else? That is it. They have the company non-current liability. Sum is equal to 14 million. 13 million, sorry, 10 plus 3, together 13 million. Then the company therefore has current liabilities. Current liabilities equal to accruals. First we have payables. Payables equal to the payable end of the year was 18 million plus the increase. Plus the increase which you've done somewhere. Increase in payables. Where is it? Here it is, 1.8 million. Then you have accruals. Accrued expenses. The accrued expenses at the beginning of the end of the year was 12 million. Plus the increase, which you have here, do it down that already somewhere. Whereas you have here 1.2 million. We have 13.2 million for the company accrued expenses. Therefore, the company total, okay, consider here company equity plus liability, equity plus liability of the company, therefore, is equal to equity was that's as 3.56 plus non-current 13 million plus current. Okay, these two, the two are current. Okay, I think I did auto. Let me just above this. The company non-current liability is equal to sum of these two. Together for the 3 million. Therefore, equity plus liability, both current and current. Here we go to equity plus liability, non-current plus current. You get 9,560. The two need to study. Have it here. This balance, okay, and the balance here. Trust the company, they need to tally, which they have done here. And that's therefore you prepare, therefore, the company pro forma balance sheet. Clear? Michelle, is clear?
Yeah, thank you.
Okay, great. That's what therefore you do, determine therefore the company external finance, as well as determining the company or preparing the company pro forma balance sheet.
So I have two questions.
Yes, question, ask.
Instead of finding the percentage increase, the amount by which sales increases and then dividing it among all the assets, why can't you just increase the assets like directly by multiplying by 1.1?
Or you just multiply by 1 point, the increase in assets, you multiply by 1.1.
Yeah. So just
Okay.
find the final value to save time.
You can do
But
so,
it can't work.
backward. You have to work this one. You don't have an option. You have to do this. I agree you can do that. That simply do the what's the increase in sale. Okay. So you're saying you do what? Increase in sale times 1.1.
No, like I have known the sales will increase by 10%.
Yes, 10%. So, yes.
All these things will have to increase by 10%, except the share capital retained, except share capital, I mean, and maybe
general needs.
Yes.
Yes, you can do that. You can do that for sure. You can do that. Yes.
Okay.
Yes, but now don't forget, for you to get the closing balances, you have to work this. I don't know whether you're going to save any time. I don't think you save, and you can do that. But now, at the end of the day, how do you get the closing balances for these figures? You see, because you have to do it individually. Plant, furniture, motor vehicle, so you have to show that working either way. But for this type of increase in assets, you can do that for sure. You simply do 10% of 99,600,000. You can do that for sure. However, to get the closing balances, you have to show this working. Okay, this working has to appear. This working has to appear. So I don't know why you're going to save so much time, but anyway, you can do that. There's no harm.
Okay.
Yeah.
And can we do May 2016 question 2?
Okay. And
Excuse me, sir, before that,
yes.
There's part C to that question. There's the third part to that question.
The weakness.
And yeah.
The weakness are the assumption.
Okay.
Yeah, don't forget the assumption of this model, some of this method are similar to the weakness method. We assume that the company is operating 100%, which is not true. Okay, quite likely we're going to have the company operating 100%. Okay, what else? That this ratio remain constant. They don't remain constant. They will change for sure. Okay, what else do you assume? That the company equity financing don't change. They may change. Okay, you may have a case where the company issues shares. Okay, you don't have mass that the company remains constant. Okay, so the assumption, the limitation. You simply try to critique those assumptions.
Question. What topic is this from exactly?
No, this topic is, I don't know where I can put it. Okay, I don't know where I can put it, but it's all over. Which I think I don't know. I think I gave the notes. I actually think they were class notes. Which if you came into class, these were actual class notes because there's nowhere I can put it.
Okay. And
yes,
then
it's
is it related to November 2018 question 4A? Are those two?
November 2018 question 4A.
Is it when you're being told to draw vertical common size statements?
No, this
what
one.
do they exactly mean?
No, yeah? This one is another. I don't know what I can call it, but anyway, it's. So vertical financial statement is simply trying to express all the accounts. Okay, if you're going to have an account for P&L, you express it as a percent of revenue. Clear?
No, I don't get you.
Let me do it really quickly here. It's a very easy. I don't know then why this is need to be okay. Let's just do it. But let me just do some few accounts here. For example, you want to express for ABC. Okay, this is for ABC company. So we begin with the way it is. The way it is prepared. Just prepare it the same way. Revenue. We have gross profit, cost of sale. This is cost of sales, and then you have here gross profit, and all the other going down. Okay, then you're going to express all this account as a percent of revenue. For revenue is how much? Revenue is equal to 4 million. There 4 million divided by 4 million as a percent. As a percent, where is it? Here it is. Okay, gross cost of sale, same thing. Okay, therefore 3 million. Okay, you can put 3 million minus. Well, this is a minus. So minus 3 million. 3 million divided by revenue, it is equal to 4 million. As a percent, 25%. Gross profit, the same thing. Okay, 1 million equals 1 million divided by revenue, 4 million. As a percent, 25%. So do that for all the accounts of the company as it is just be prepared. That you do all the until the profit after tax. Okay, all the until the profit tax. You simply express the account as a percent of revenue. That's for the case of the P&L. For the balance sheet, you express them as total assets. Total balance sheet for the company. Okay, we begin. The first one is the company, land and building. The next one is furniture. For the building, we express them as total assets. For all the assets, all the company account, you are going to be expressing them as a percent of total assets. And the building is here for this account is 1.2 million. We do it as a company, which is equal to 150. That 150. You do a percentage of it. Furniture is equal to 600. To assets that 150. This equals. Okay, percentage. Again, 90%. You do for current asset, same thing. Inventory, express total asset, all the accounts of the company. That's clear.
Oh,
That is
yes,
why I
it's
was-
clear.
That is why I was saying there are so many strange things in these
Yeah,
papers.
I don't know. That's why
They
some
carry a lot
things
of
that
marks.
okay, I don't know. You just hope that your examiner is not going to bring some things way out of the topic. That's the thing. But as I was saying, okay, the best thing is to prepare for the exam. Simply ensure that the areas that are within the syllabus, you know them very well. Okay, even if maybe the exam is going to bring a question from maybe out of the scope of the syllabus, you have already done the others. Okay, so don't worry too much about it. Clear?
Yeah.
Okay, great. Any other question?
Can you do the May 2016?
May
Again,
2016. I
it's
hope it's not a
under
long
concept.
question. May 2016 question.
Question 2. There's the one for super profits.
Also for profit. Okay, May 2016
May
question
2019, sorry, question 2.
2019.
Yeah.
May
Question 2.
2019 question 2.
2. Yeah.
May 2019 question 2A, 2B. 2B Roman 2. So May 2018 question 2B Roman 2. Okay, go through it. Okay, I suppose you've gone through it. But this is one of the area where some, I don't know, anyway, exercise question from the examiner because it's a question from all over. Anyway, so first we determine this company, we need to get the value of the share using the super profit model. Okay, so first we determine therefore what is the company normal profit, because okay, before you use the super profit, okay, first you get the company normal profit. Therefore, the company normal profit, okay, is given us, okay, simply given us the company, the capital you have invested, okay, times the return that it makes for you, okay. Therefore, you have invested how much? 48 million. That's what you have invested. 48 million. 1, 2, 3, 1, 2, 3. We multiply by the normal return you get. Okay, the normal return you get is equal to 12%. That's the return on the assets. Okay, and then we get therefore normal profit of the company equal to 5670, 5760. 1560 to be the profit, the normal profit of the company. Okay, therefore the super profit of the company, super profit is the extra profit. Okay, super profit therefore is equal to, equal to the normal profit, the average profit of the profit minus the normal profit. Profit you have just made minus the normal profit. Okay, so what's the company profit? The company profit is 10 million. So therefore 10 million equals 10 million. 1, 2, 3, 1, 2, 3, minus the normal profit you're going to have made, okay, which is 1560. Therefore, we have made a swap profit equal to 1420. Okay, clear?
Yeah, it's clear. So only that for 4 marks.
No, you're not yet done. I'm asking so far is this clear?
Okay.
Okay, great. Therefore, we get a swap profit equal to 4.2 million. Therefore, to get the company equity value, the company total equity value. Okay, let me just put it here. The company equity value will be equal to the profit you capitalize. Now you capitalize the profit. Okay, is equal to the 4.2 million you've just earned. We divide the company. We divide first. We divide the company. Okay, the rates you call the rate of capitalization. In this case, simply the return on assets, 0.12. Okay, if this was a swap profit to be earned by the company to infinity, okay, what is the company? What's the present value of those profit you're earning? Is simply the profit divided by R, which is equal to 4.2 million. The swap profit, okay, you divide by R together for that 5333. Is that clear? Okay, this is similar to the present value of this profit you're making. 4.2 million, you capitalize it, or simply get the present value, okay, is equal to 4.2 million divided by R, and R here is equal to 12%. Clear? Therefore,
yeah,
the equity value per share, which is, I think you've been asked here, per share, therefore be equal to the amount you just received, total value, that 5.333, we divide by the number of share. How many shares does this company has? 2 million. You divide by 2 million. 1, 2, 3, 1, 2, 3. I guess 17.67 to be therefore to the company equity value using the swap profit model. So this is another model where there's nowhere that is within syllabus.
so and the 5 years
5 years, who is the 5 years?
for the next 5 years.
Yes, this is for the next 5 years. Okay, okay, this is for the next 5 years. What do you want to do? This is an assumption you're making that this profit is going to be earned to infinity.
No, like when they tell you they'll receive a profit for 5 years, don't you use the present value of?
Oh, for only 5 years.
5 years, yeah, because they've told you for 5 years somewhere.
Because now in case no, what happened after the 5 years? But the company is not going to end at year 5.
Okay.
That's the other thing you have to know, that this, okay, I don't know, you have to assume that this is going to continue until infinity, because the company is not going to come to an end until year 5. Unless you make that assumption that the company comes to an end in year 5, then it makes more sense, okay, to do this until infinity. Unless you assume the company comes to an end in year 5, where you're only going to discount until year 5, you can do that, but it doesn't make any sense for sure.
Okay.
Yeah, unless you say the company profit, unless maybe the examiner has gone ahead and clarified that, hey, Once we are at the end of year 5, then the company's for profit cease to be there. There's no any further for profit to be earned year 5 onward. But if there is no that clarity, then I would want to assume that this goes to infinity. Or you can do the other method where you assume is the company's for profit comes to an end in year 5. So from year 6 to infinity, there is no any super profit. We can do that, by the way. Okay, that's another way you can try to do the question. Okay. Where in that case, therefore, what to be up, and therefore you discount only for 5 years. Therefore, big or 2.
Excuse me, sir.
You can do that. Let us do that method you're saying. Assume yes.
Excuse me, sir.
Just a minute.
Okay.
So here, number we assume no super profit, super profit. Okay, from year 6 to infinity. There's no super profit. You can do that assumption. But as I mentioned, in case you do assumption, then ensure the assumption you're making is the first line, okay, in your solution. Yes, someone was asking something.
Oh, yes, it was me. Could you send a photo of this question?
I'll send this
Thank you,
example like in the group. Yes, I'll send this in the group. So in this WhatsApp group, I will share this. So if we are to make this assumption, let's do it. Okay, therefore to be equal to the profit will be earning will be equal to the 420, but only for 5 years. Okay, will be equal to 420, but only for 5 years. Therefore equals times the profit, the present value earned factor 5 years. Okay, 12%. Okay, and I can use the tables quickly. 5 years, 12%. The factor is equal to the 648, 3.6048. Okay, that's what you get. Okay, then we divide the number of shares. That's the curve of equity value divided by the number of shares, 2 million, 2, 3, 1, 2, 3, and get 7.64. So I don't know what you want to assume. If you want to assume that the period for profit is only for 5 years, then this is the answer. Therefore, if you assume it continues, okay, it doesn't count on it, okay, and therefore this is the answer. I don't know. You have to make the assumption. You have to do the assumption before you begin the question. Clear?
Yeah.
In the question before the class?
So part 1 of that question asks you to use the dividend growth model. So we just use the normal one, the D naught.
P naught is equal to D naught 1 plus G divided by RE minus G. Yes, same method.
But they gave 6 marks, so I was wondering maybe there is something extra.
No, there's nothing extra here. The only thing that I think is not given to us is what? Can you get the D naught?
Because
yes, can you get the D naught? Can you get the G? Yes, you need to get the G. Okay, you can get the G. Good.
Yeah.
G is equal to?
G is B times R, where R is the expected rate of return.
Yeah, that is it. Nothing else. There's nothing strange there. I think the only thing that is a bit complicated to get there, G. Once you have the G, then everything else is a bit easy, isn't it?
Okay.
Yeah.
And then, sir, for those of us who joined today, could we have the access to the past 3 classes, what was done, the recordings, the Excel worksheets, please?
Okay, I can try to do that. I can share in the group. I hope all of you are in a group, isn't it?
Okay, no problem. That will be great.
I can try to share the recordings in the groups that the 2 respective groups.
Yeah.
Any other question? Yes. Oh, no question.
I have a question.
Yes, ask.
When you're told to differentiate between systematic risk and unsystematic using a diagram, what diagram do you do?
There's a diagram that we drew together where you make a distinction between the systematic and the 2 risk. Okay. Let me first share this Excel with you guys. I hope you can remember this model, this graph. If you remember when discussing on the portfolio theory, okay, when you discuss the portfolio theory, we see that as an investor, okay, there are two risks that you're exposed to. The what called the risk of systematic and the risk of the unsystematic risk. Instead, in case you increase your number of assets in security, here's the number of securities, number of assets or securities in your portfolio. If you reach 30 securities in your portfolio, from 16 to 30, then you'll be able to have been able to diversify all your risk. Okay, all your non-systematic risk. Okay, this is a risk. Okay, so in case you increase the number of securities from 0, okay, then you'll be able to diversify some risk. There's some risk you'll not be able to diversify. Okay, because that's referred to as the unsystematic. So this risk here, the one you're able to reduce, okay, in your portfolio, in your investment, is referred to as the unsystematic risk. However, there are some risks that you can't be able to diversify, okay, to do away with. Okay, we'll call the systematic risk. This component we'll call the systematic risk component. This is a graph, for example, asking you to draw, okay, making distinction between the systematic risk and the unsystematic risk. Michelle, you know this graph? How will you still remember it?
Yeah, I remember. Okay.
Yeah, this is what the examiner is asking you to draw in that particular question. In the question, okay, the question. Then
Yeah.
I wish you all the best in your exam. Okay. In case you have a question, you can share it in the group. Okay. I will still be in the group. Okay, until the exam. If you have any question, you can forward it there. Okay, for others to see and others to discuss on it. And in case you have a question, I'll also try to make an attempt. Okay, on that question. Okay, so in case you have any question, I think you can use the group as our forum for discussion. Okay, all the best in the exam.
Can we have a class on Monday, sir?
On Monday? Whoa, I have tried to do that in the past tense. Stralmo has an issue with having those classes, so I highly doubt whether that can happen.
Okay.
Yeah, I highly doubt whether that can happen, unless a miracle happened. Because the last time I tried to ask them for us to make up classes, they said it's not possible for us to do that. So I don't know, unless I try to see if they can agree. I highly doubt because they're going to agree, but if they agree, then I will let you know.
Okay.
Any other questions? Someone else had a call.